Welcome to the next episode of Time to Talk. Time to Talk is the podcast from Time to Market where we talk with energy leaders, inspiring people, experts from the industry who know all about energy and trading. Today we welcome Marcello from Clever Markets. Hi Marcello, how are you doing today?
Hey, hello, I'm doing very well. How about yourself?
Very well. Looking forward to today's chat. Could you please tell our audience what we are going to talk about today?
Yeah, absolutely. I'll just give it a go with an introduction. So my name is Marcello Kolax. I am the managing director at Clever Markets, and we are the energy industry's first remote technical analysis desk for hire, essentially, that you can get on a subscription. I've been in the energy industry for around a decade now, first on the fundamental side, and I realized that, I still can't trade with that. So I moved over to technical analysis and then founded Clever Markets last year.
Thank you for that introduction. You already bring an interesting topic about the difference between the fundamentals and the technicals. And me, myself, with a background in trading, I've used both of them a lot, of course. But could you emphasize a bit on why you believe the fundamentals are not as much driving as the technicals when trading these markets?
Actually, I do have this question almost every single day with prospective and current clients. The common conception is for energy markets that, energy markets are driven by fundamentals. Technicals don't work. Or it's always like a variation. Sometimes it's like, technical analysis doesn't work on the prompt, or technical analysis doesn't work on the FAR curve because it's all driven by fundamentals. I'd rather step back and say that the energy markets, they don't move on fundamentals. And they don't move on technicals, they only move on a perceived shift in supply and demand, right? And we have two methods of analysis available to us to make sense of this perceived shift in the supply and demand balance. And we can use fundamental analysis, where we start building our own version of reality. Yeah, I did that for many, many years, where I start looking at weather forecasts and pipeline throughput, and I talk to traders for sentiment, and then we build our own models, our own fundamental models to replicate reality. And then there's different kinds of fundamental models, but usually it gives a rough direction. Are we in an uptrend? Are we in a downtrend? Or sometimes these models give us a fair value in quotation marks where the price should be. Technical analysis, on the other hand, doesn't care about the reason why the markets are moving. It only cares about what is actually happening and where we are. Because we need to know, are we in an uptrend, or are we in a correction? Are we in a downtrend? Are we at a turning point or in a sideways trend? So with technical analysis, we can answer all these questions. I feel trading essentially is like voting, right? So every single trade is like a confirmation of the direction. And if the sentiment changes, then that sentiment shift is reflected in the price slowly going down, like one trade at a time. So essentially with technical analysis, we're just looking at what everyone else thinks the supply and demand balance is. That is essentially the big difference. So it's not driven by TA or FA, it's driven by a perceived shift in supply and demand. And you can either create your own version of reality, or you can simply look at what everyone else is doing.
Thank you. Interesting standpoint. With my background in trading, I also did quantitative modeling of the 𝐓𝐚𝐴 algorithm. It's very short term, very fundamental driven. It's a different regime in that sense than the technicals I think that you are looking at. But one of the major things that determined the quality of a fundamental forecast was your assumptions. As you said, you make your own version of reality. And my words there are, you make your own assumptions on how reality is going to look like. And having wrong assumptions there will give you a wrong forecast. When making the jump now from the fundamentals to the technicals, do you think that in the technicals you're dealing with just as many assumptions or very little assumptions? Or is it just the facts that you're looking at, the price, the volumes, or derivatives of that?
So one of the reasons why I fell in love with technical analysis is because we don't need to make many assumptions. We are just trying to display what the market is already doing. technical analysis marketing in general out there, not just in energy, just in general, is based around like forecasting and predicting, and like, TA is seen as this like crystal ball thing. But technical analysis in my book is something very, very different. So TA is only there to do three things. It is there for trend identification, trade planning, and risk management. So TA and FA actually, they work really well together, right? In terms of like a trend identification. So you have your fundamental reasons why the price should go up, and then you can actually see if the price is moving up because the rest of the market sees it the same way. And the worst thing you can do is having a fundamental model that tells you we are bearish, and then you just, the market moves up by like 20 euros and you just try to find selling opportunities, as it was the case in, was it like last year with Myanmar, where the price went from 20 to 50 and traders were telling me their models are bearish. So on the way from 20 to 50, they are trying to short sell the market. So this, of course, backfired. So with technical analysis, we don't need to make any assumptions. We're only seeing the market is moving. So now let's profit from that. TA is only trend identification, trade planning, and risk management. Even the most hardcore fundamental traders, they're still looking at round numbers and old peaks and trend lines, and that's called chart reading. All of that is also TA.
Thank you. When we look at the markets that you are looking at, and we're talking about energy now, but energy is still a very broad market. We can talk power, we can talk gas, EUA, LNG, time spreads, location spreads. Can you give a bit more information on where your passion lies, where your expertise lies, and why?
Of course. So since my background is in European gas, that is also the focal point of Clever Markets. So I cover the TTF, NBP, Brent, carbon, coal, EUAs, and just a little bit of FX, just for the exchange rates. More markets are being added very, very soon. I have the feeling, you have to tell me, I mean, when I talk to traders, it seems there's only like 3 markets that actually matter, yeah? It's like JKM, TTF, and maybe a little bit of Henry Hub. These are like the leading markets. And I mean, with the globalization of gas, TTF has become more or less like the global reference point, or at least in Europe. That's why I feel, and I want to hear your opinion as well, I feel there's a lot more global conglomerates which previously have had no interest in European energy, who are now entering. So I'm talking like fleet optimizers, like trading houses across Asia, especially Japan and Korea. You have like portfolio managers, hedge funds from the US, even like family offices. Like everyone is now interested in trading TTF, and the market has become way more sophisticated over the past, I don't know, maybe like 2 years, I would say.
You're making a very nice bridge there, Marcello. Thank you. And this is, of course, what we see at Time to Market as well. We bring our clients to the market, and we see indeed a very high influx of new market participants from all kinds of angles. And it can indeed be hedge funds, it can be family offices, it can be large players. We see all of them. And to our surprise, there's still a lot of interest on the power side. And so we do the work on the physical setups, mostly physical power, physical gas, mostly in the European markets. But we have been surprised by the amount of interest on the physical power. We believe it could also have to do just with the complexity of the setup, the resources that are required, the financial capital that is required. We're doing quite a lot of gas setups as well, but the majority with us still lies at the power.
I would guess the German power markets might be the big reference there, or?
So what we typically see is that the German power markets is something that a lot of market participants want to go to who are not too familiar with the energy markets, but many of them who are not so familiar with the markets do not know the challenges of the German market on market setup, market entry, and how much you can speculate. And that is something where we really see this knowledge gap between those with energy experience and those without energy experience.
Oh, okay. I have noticed that also, especially since you mentioned like the difference between like physical or speculative trading, paper trading, however you want to call it. I feel that like technical analysis is helping like both parties. It's both the physical and the spec traders, because the only question, because I get this question quite often, yeah. So Marcello, I'm only like hedging, or I'm only buying volume for because they're in a procurement department or something, yeah. TA still applies, because the question we have to ask is, does TA apply to me? Is it useful for me in my role? The only question we have to ask is, do you need to know where the price is right now and where it's most likely to go? So if the answer is yes, then TA can help with that, essentially.
I want to make a jump back to your previous statement about the three functions that technical analysis has to you. And one was being trend identification, which traders, of course, love. Jump on the trend and ride it as long as you can. And the third point you mentioned was the risk management. Can you give an example on how you apply your knowledge on risk management in your technical analysis and how it can be used in trend reversals?
Oh, yeah, absolutely. Okay, so the three actually work very closely together. So imagine we are in an uptrend and we have identified that with our fundamental picture, and also the market actually is moving. So TA, or the price, is also moving higher. So now we are, let's say, in an uptrend. That doesn't mean that like every opportunity is good, right? So we don't want to buy directly at the top before the market moves lower. So then we go to trend identification, from trend identification to trade planning. It's essentially, okay, now we know we want to buy, but where do we buy? And of course, ideally, it's always like in the troughs before the market moves higher to the next target. And with the trade planning aspect, now we go, okay, what is the point of no return? When do I know that the trend is actually going up? So that's where you set your entry. Then with different technical tools, you can establish a minimum upside target, or you can let the trend go, or the trade go for as long as it lasts, right? And most importantly, I feel technical analysis tells you when you're wrong. And it tells you when you're wrong early. Because when you're wrong, that's fine, but you want to be wrong early, right? And once we know where to enter and where to exit, the potential target is, that's where we can then start looking at risk management, right? So you can start looking at position sizing. You can look at your risk-reward ratio, so you can only pick out trades that are beneficial for you. You can start hedging with the help of technical analysis. So you can do your market selection as well. In terms of risk management, you can also start using like different technical methodologies, which is a risk diversification method in itself by running different systems.
While you were talking about getting your confirmation on a trade, I would like to jump there. What do you consider a confirmation of a trend that is initiated? Let's say we have it seems to be a reversal. We believe now after a downtrend, the market is turning into an uptrend. What would you technically consider confirmation?
Okay, so essentially this is like a full-on 90-minute lecture from the Clever Markets Academy as well, but I will make it short. So essentially, an uptrend is defined by higher highs and higher lows, and a downtrend is defined by lower lows and lower highs. And then we have like different, then we can draw in trend lines as well, and we can confirm it with trend and momentum tools. So if all these align, then usually we get let's say a good uptrend going. As we reach a peak, we would usually see that like the trend and the momentum, it's all a little bit lagging. It's like falling behind. The market isn't moving as high anymore. And then as soon as we make the transition from higher highs and higher lows to lower lows and lower highs, this is like the clear-cut way of determining now the trend has reversed. And that's why I like TA so much, because no matter how convinced we are of our fundamental models, if nobody else sees it the same way, then does it really matter? Like, imagine, like the skies are opening up and there's like a beam of light coming down, and you get to receive a little box and you open it, and then you get the true value of the TTF for today, and you're the only one in the universe who knows what the true value is. Does it really matter if nobody else thinks it the same way? Because the rest of the market is still doing their own thing. So whether or not you are the one with the perfect fair price, it doesn't really matter. We still need to do what the rest of the market is thinking, right? And that's where TA helps with, and can distinguish between like corrections and uptrends. I like to work with Fibonacci retracements quite a bit. I like to work with an 8 and 12 exponential moving average. So these like a lot of tools that can be combined to just distinguish between corrections or full-on trend reversals.
Thank you, Marcello. And also a nice metaphor there with the beam of light coming from the skies.
Because, right, it doesn't really matter, right? I mean, if we are truly the only ones who know, we are still just trading at what the rest of the market is thinking.
One question that I had now while you were talking about this, technical analysis is a broad topic, of course, and you have it as simple as trend lines, trend identification, moving averages to our more complex derivatives as the MACD, the RSI.
Yes.
You also mentioned, for example, the Fibonacci's. You started talking about 8 and 12 moving averages. They could be simple, they could be exponential, and we can drag this pretty far. You can get more complex derivatives, more complex information, third derivative indicators, but you get more and more away from what is really happening, which is basically price and volume.
True.
What are your thoughts on how leading everything is? How much do you really want to stay true to the real truth, price and volume, and how much do you believe that all these derivative indicators can still add value?
So you're absolutely right. So chart reading is still the primary source of like any sort of like price trigger. What seems very seductive of technical analysis is there's like so many tools and they all seem to give like so many clear signals that it's very easy to just jumble a few things together, but in the end nothing amounts to like a real system. So I think the best thing is to step back and identify what can we even use. So there's only like 5 kinds of tools available on the mathematical side. There's trend, momentum, volume, volatility, and oscillators. I would suggest fully pick one that you find intuitively like the most interesting, something that you get immediately, something that aligns with your thinking process, and just pick one out of each category. And then in the end, you'll probably just end up with like 3 or maximum 4 tools. I would often suggest 1 trend, 1 momentum, 1 oscillator tool. I mean, volume is there, of course, as well. And then just keep it simple. Any of these mathematical tools, they're really just a derivative of price. So everything is already on the chart. And what's on the chart and the prices are moving and lines are breaking, this is always the primary trigger. And I use the mathematical tools only as a secondary confirmation of what I can already see on the chart. So I would never ever make a trading decision based just on a mathematical tool. It must always be accompanied with a real price move.
That makes a lot of sense. Thank you. When you're trading these markets, and I want to jump now to your videos that you sometimes post on LinkedIn, which are just great educational videos. And you look, of course, very short term, let's say the intraday market fluctuations, and you look more long term to identify your stronger, more leading trends. Could you walk us through on how determining your intraday price levels are and how determining your open and your closes on a trading day?
Last traded price, that's what I'm using, not the closing price. And overall, like how they all fit together. Not sure if I'm answering your question here correctly, but for a lot of traders, the primary time frame seems to be like the daily chart, for example. And with the daily chart, we can look ahead maybe like 2 weeks, maybe 3 weeks. That gives us like a little bit of an outlook there. And then we would look into the higher level time frame, so the weekly chart, in order to determine like the rough direction of the market. And if the weekly chart is bullish, then we would be looking for buying opportunities on the daily chart. And if the weekly chart is bearish, then we'd be looking for short selling opportunities on the daily chart. So just as a rough indication, it's like one really good filter. And now we want to be even earlier. So we start looking into one lower level time frame. So that might be, I don't know, maybe the hourly chart or 4-hour chart, yeah? Because there we can be like really precise and maybe catch a trend very early. Or once we are in a trend and we see it's weakening, then we see it's weakening very early on the hourly chart. So essentially the analysis is top down, weekly, daily, hourly, but the price is moving from hourly, daily, weekly. So this is how it's like filtering through. Now with a 15-minute chart that I analyze, this is not even giving us like a full day of an outlook. The 15-minute chart really is just there for the first, I don't know, 3 hours, 4 hours of the trading day, and that was highly requested by my clients. So that's why I'm essentially skipping one step between daily, hourly, 15 minutes. I go directly to the 15 minutes.
Clear. If I may try to conclude something from your wording here. You are saying, of course, the 15 minutes is important. You can use it for the first few hours, but basically we want to look at the daily and the weekly to identify our trends. Companies have their own risk management in place. Desks have their own risk management. Traders have their own risk management, while you also have your expertise about risk management. Do you dare to take a statement that intraday price levels should not be used for your stop losses on a strategy?
I have never come across this statement. No, I feel if you're an intraday trader, then of course put your stops intraday, because I do work with a lot of traders who are just really on the screen for like, I don't know, 1 or 2 hours at a time. So they want to just get in and out of trades fairly early. So I think that does make a lot of sense to put your stops on the intraday chart anywhere, like 15-minute, hourly. I think it makes sense, yeah.
Yeah, so you just draw the line basically. What is the time horizon of your strategy? And if it's long-term, then the intraday levels are insignificant.
Oh yeah, they can create a lot of noise and confusion, absolutely. Yeah. Let's say you're a swing trader and you're planning on like trading like a full swing of like, I don't know, 3 weeks of an up leg or something. Then starting out with a 15-minute chart is not going to do anyone any good. It's like way too much noise. It is not significant enough. And you'll be just thrown around by the market and you'll just be nervous. So you're absolutely right, yeah. For the longer term, medium term, like swing or position trading, I wouldn't recommend looking at the 15-minute or hourly chart, actually, yeah.
Thank you. You are dealing with a lot of different people at different companies. It's all about technical analysis, of course, but if we can now look at a bit more specifically the traders, those who make the trading decisions, what do you think is their biggest misconception or their biggest mistake that they make while using technical analysis in their trading?
What I observed, like not the biggest mistake, but like an area of improvement for traders is thinking that they are either a technical trader or fundamental trader. And I feel there's a lot of like emotion and pride and ego attached to defining yourself as a fundamental trader or as a technical trader. But I feel we are not trying to be fundamental traders and we are not trying to be technical traders, right? We're trying to be good traders. And good traders take like all the information in that could possibly provide an edge. And I think that distinguishes like an average trader from a really good trader who's actively seeking out an edge, so to improve their P&L. So I feel like being too stubborn and narrow-minded about I am a fundamental trader, I am a technical trader. I feel combining the two always yields the best results. We are not trying to fight some ideological battle here. We're just trying to make some money.
Fair enough, yes.
Once they are moving on to technical analysis, I feel the biggest mistake is, there's actually two. Being too cautious because there's like too many signals and they are not properly filtered and there's no strategy behind that. So essentially like paralysis by analysis. And I was the same when I started. There's like a billion things you can look at and all the tools look very fancy and complicated. And honestly, you feel very cool if you have like 3 screens with like squiggly lines on your screen and your trader colleagues don't really know what's going on. And you catch your first good trade. So it is very seductive to just put on more and more indicators. But truly, keep it simple. I think just trend, momentum, oscillator, maybe a little bit of volume. This is all you need for the beginning. Pick the tools that you fully understand to avoid like paralysis by analysis. And I feel this is like the biggest mistake. They're trying to incorporate too much too quickly.
And I think with that, Marcello, we are nicely rounding off our conversation. I mean, your statement, keep it simple, paralysis by analysis. I think it's two very strong statements that we can definitely conclude our conversation with. So I would like to thank you for today. To all the audience, of course, please connect on LinkedIn with Marcello as well. Have a look at the Clever Markets website and the LinkedIn page. Look at the videos and see how valuable the content is of Marcello. And we would really like to thank the audience for listening, and Marcello, of course, for you for being available today and having this really interesting chat with us.
Thank you very much for having me.
Now, that was great, right?